I am Bahaudin, Mujtaba, and today we're going to talk about compensation and pay. A very favorite subject to all of us, obviously, because when we go to work, when we are doing something for our companies, for our society, obviously we want compensation that is equitable for our work and for our services and contributions. When it comes to compensation, I think we need to have two different perspectives. There's the employer's perspective, and then there's the employee's perspective. So from an employer's perspective, we can look at pay being critical in attaining the organization's strategic goals. Pay impacts employees' attitudes and behaviors. In other words, what they do, how well they do it, how much effort they put into their work is related to compensation. So employee compensation is a significant organizational cost as well. In other words, for most companies, a very large portion or percentage of their overall revenues or expenses. On the other hand, when we look at things from employees' view, we need to keep in mind that policies regarding wages, salaries, and other earnings tend to have an impact on the overall income and standard of living for us as employees or associates of an organization. Both the level of pay and fairness compared with other people's pay are important elements in us viewing our pay as either being equitable or perhaps not being just or fair. So employee compensation includes all forms of pay or rewards that are going to the employee, which arises from our employment in the organization or in the department or in the community. So compensation can be in direct financial payments, or it could be indirect payments in the form of benefits and so on. So direct financial benefits are payments in the form of wages, salaries, incentives, commissions, and bonuses that employees receive throughout their employment, from daily to weekly to quarterly or to annual basis. Indirect payments are payments in the form of financial benefits like employer-paid insurance and vacation and other benefits that we tend to receive. The basic pay factors could include the law or the legal system in any region or city or country. Sometimes unions have a lot to say about how much employees are paid. And there might be policies strategically in terms of a company's overall goals. So some companies may choose to pay a little bit above the average wage in the industry because they don't want to provide as much training. So if they pay a little bit more, that means you might attract experienced people from other organizations or from competitors, so you reduce your training costs. On the other hand, if you bring in new employees and you pay maybe below average or a little bit less than your competitors, then you might have to provide a little bit more training simply because you cannot get the experience that you always need. So the other element of pay factors would be, how fair is it? How is it perceived by the employees who are doing the job? So we want to make sure our payment systems are perceived as equitable by all employees. With regards to the Fair Labor Standards Act, it tells you a little bit about the minimum wage requirement in the city where you're operating or based on the federal law that you're required to pay employees. It can also tell you the maximum number of hours employees can work based on their status as either full-time or part-time and the benefits that they receive, as well as in some cases the age. So if they are under 18 years of age, sometimes they cannot work too many hours because they're attending obviously school. The Fair Labor Standards Act also might have something to say about overtime pay. If people are working over 40 hours and they're not managers or they're not exempt, how much you should pay them or how you should pay them based on overtime. How about equality of pay? Also, the Fair Labor Standards Act requires us that we have equal pay. In other words, there should not be any differences between a person's salary simply because his or her gender is different than everybody else. The Fair Labor Standards Act also tells us about what kind of records we need to keep. and also child labor provisions covering the majority of the U.S. workers. So in some cases, obviously, companies do rely on part-time workers who are high school students or college students, but if they're under the age of 18, specific laws might apply in that case. So in terms of compensation policies and strategies, keep in mind that, for example, a specific hospital might have a policy of paying, let's say, their nurses or other medical professionals a wage that's at least, let's say, 10% above the prevailing market wage. So the compensation should support the employer's strategic goals. So equity exists when an employee perceives that the ratio of his or her input or level of efforts to their outcomes equals the ratio of other employees both within and outside of the organization. So in a way, you can measure external equity versus internal equity. In terms of external equity, keep in mind that an employee's pay must compare favorably with the rates in other companies. Otherwise, a company or a manager will find it very, very hard to attract and retain and keep, obviously, good or talented or qualified employees. On the other hand, internal equity tells us that each employee views his or her pay as equitable, given other employees' pay within the same organization or same department, or in some cases, obviously, in other locations within the same company. So people evaluate the fairness of their pay situation by comparing them with those of other individuals. A person compares his or her own ratio of perceived outcome to perceived input to the ratio of comparison others. Obviously, if the ratio is smaller than the comparison other ratio, then we consider that under reward and equity. On the other hand, if a person's ratio is larger, then we call that over reward inequity. So if we find that there's no equity, how do we restore equity back into the compensation or the pay? Well, there are a number of things you can be doing. We can change inputs, so the employee can see his or her salary as being fair to others internally or externally. We can change outcomes. We can change attitudes. We can change the reference person. We can change the input or outcomes of the reference person. Or the person can simply leave the organization and obviously find another job where he or she feels as though they're paid equitably. Ultimately, if you're a manager or HR professional, we need to establish pay rates. In this case, we can do a salary survey. Employee committees could determine the worth of each job within the department or the company. We can group similar jobs into pay grades. We can price each pay grade by using some sort of a wage curve, and we can develop rate ranges. As part of the job evaluation method, we can use perhaps the ranking method, which ranks each job relative to all other jobs based on a compensable factor such as the difficulty of a job. So using the ranking method can obviously help you determine compensation as well. We can have job classification, which is a widely used method to categorize jobs into groups based on similar compensable factors such as the skill level required as well as the responsibility that's required for performing a job effectively. So the groups are called classes if they contain similar jobs, or they can be called grades if they contain jobs that are similar in difficulty but otherwise somewhat different. So the ranking method ranks each job relative to all other jobs, and job classification requires managers to categorize jobs into groups based on their similarity in terms of compensable factors like skill and level of responsibility. Pay grades comprises jobs of approximately equal difficulty or importance as determined by job evaluation by the committee, task force, or obviously you yourself as a HR professional if you have the expertise on compensation. And obviously, some people at the top level are paid a little bit differently than those who are in the lower ranks of management or employment in an organization. So in this case, you have to be concerned about how to pay executives in the organization. So not only they can remain productive during their tenure in the organization, but obviously that they increase productivity, they increase revenue, they increase market share, they increase other important elements so your organization can stay sustainable and successful long term. When it comes to executive compensation variance, usually we have to consider the job complexity, how much actually we can pay top level managers compared to others in the industry. And also we have to look at human capital. So the human capital, the ability to pay, and the job complexity determines how much compensation we can pay to individuals, whether they're managers or senior level officials in the organization. Sometimes we can have incentive plans to encourage high-level officials, obviously, to be productive. So individual incentive programs give performance-based pay to employees who meet their individual performance standards as agreed upon by, obviously, you, their manager, as well as the employee, him or herself. Variable pay groups pay plans that tie payments into productivity. So in other words, we are trying to provide reinforcement. We link productivity with specific bonuses or incentives. Most companies pay their salespeople a combination of salary plus commissions. So think about the automotive industry where the more cars I sell, the more money I will be making. Typically, a 70% base salary and 30% incentive mix might be included for most jobs where salespeople are involved. Many companies also offer recognition-based awards, so it doesn't always have to be in the form of direct income in terms of salary, because you can recognize people and still get the same productivity and obviously meaningful purpose associated with it on the part of the employees, so they can stay productive, so they can feel happy and equitable in terms of the amount of benefits that they receive from the organization. Recognition has a positive impact on performance, either alone or in conjunction with financial rewards. So don't forget that recognition is a cheaper way often to keep people productive and engaged, and letting them know that you appreciate their work. You can provide gift certificates, cash rewards, merchandise incentives. You can send employees to training programs, provide work-life benefits or balance, and also think about sometimes sending people to workshops or conferences or for individual travel where they can go with other colleagues or they can go with family members. So that could be another form of recognition. And obviously you can think about having employee of the month, employee of the year, and so on, recognition programs with your organization to help recognize those who go above and beyond the call of duty. As part of incentive plans, you can have merit pay. Merit pay would be any salary increase awarded to an employee based on his or her individual performance. So that would be an example of obviously recognizing people based on the hard work that they do. On the other hand, you can have profit sharing plan, a plan whereby most employees share in the company's profits. It can be current or it could be deferred. In other words, they can receive the benefits immediately or in short term, or it could be postponed until retirement. Another incentive plan is gain sharing, an incentive plan that engages employees in a common effort to achieve productivity objectives and share the gains collectively between employees, managers, and obviously the stockholders of the organization. Employee stock ownership plan is usually applied for senior managers, but in many companies nowadays, lower level employees and lower level managers also are sharing in this ESOP plan. So a corporation contributes shares of its own stock or cash to be used to purchase stock to a trust established to purchase share of the firm's stock for employees. So many companies are doing this, and obviously it's a way to make the employee be an owner of the organization where he or she works. Even if an employee owns just 1, 2, 3, 4, 5, or 100 or 1,000 stocks, it doesn't matter the amount. Usually we feel good that I am the owner, therefore I treat the company and obviously my job as my own organization. You can have Scanlon plan. Scanlon plan is basically a philosophy of cooperation, provides identity, competence, involvement in symptoms, and sharing of benefit formula. So what does this mean more specifically? A Scanlon plan is a typical gain sharing plan with several basic objectives. So number one, it is based on a philosophy of cooperation, which assumes that the managers and workers develop a sense of ownership within the organization. Second, there's employees' identity with the company's mission and understanding how the business operates, for example, in terms of dealing with customers and obviously a reduction of cost on a continuous basis. The Scanlon plan demands a high level of competence from employees at all levels. So there's a continuous development on our part to make ourselves better and more value added or more valuable to the company. The Scanlon plan's involvement systems takes employees' productivity improving suggestions to the department level committees, which transmit the valuable ones to the executive level committee to implement or consider for implementation, obviously either immediately or in the future. Last but not least, the sharing of benefits formula assumes that all employees share directly in any extra profits resulting from their cost-cutting suggestions. So if we want employees to be engaged, then obviously do it through a total quality management program, do it through offering incentive programs, or Scanlon program also can be very helpful. The goal here is to offer employees many ways to be recognized for their additional efforts or when they go the extra mile in the organization to serve customers, to cut costs, or obviously to be a good team player. When new workers see equity in their direct and indirect compensation and benefits, they will obviously stay motivated and have a longer tenure in your organization. So keep in mind that in various countries, people work a different number of hours. Research shows that Mexicans, for example, work almost 500 hours annually more than we do in the United States. And similarly, the Koreans tend to work about 320 hours more annually than we do in the United States. We, on the average, work about 1,790 hours per year. However, there are many, many individuals around the globe that work less hours and enjoy a similar or perhaps even better quality of life in the workplace. So think about the Japanese. They work 70 hours less than us as Americans. The French work 308 hours less than we do in the United States. And finally, the Germans tend to work about 419 hours fewer per year than us in the United States. So where would you obviously rather work? Think about quality of life benefits that organizations offer nowadays to attract and retain the best employees in the industry. So benefits could be direct or indirect. Indirect financial payments to employees could be in various forms and may include health and life insurance, vacations, pension plans, education plans, and discounts on company products, etc. The supplemental pay benefit typically is one of an employer's most expensive benefits. So this could include holidays, vacations, sick leave, military duty, and even jury duty. Severance pay is usually a one-time separation payment when employees are leaving the organization, retiring or moving on to another organization within the industry or outside. Workers' compensation provides income and medical benefits to work-related accident victims or their dependents, regardless of obviously whose fault it is. So this is another huge benefit that encourages or discourages people from joining in your company. In the United States, we also have COBRA. the Consolidated Omnibus Budget Reconciliation Act. The Consolidated Omnibus Budget Reconciliation Act, otherwise known as COBRA, of 1985, requires companies to permit their workers to extend their health insurance coverage at group rates for up to 36 months following a qualifying event such as retiring or termination, a reduction in hours that leads to loss of health insurance, death, or even other such events. Since 1993, the Family and Medical Leave Act requires companies with 50 or more employees within a 75-mile radius to provide as much as 12 weeks of unpaid leave after childbirth or even adoption to care for a seriously ill child, spouse, or even a parent, or for an employee's own serious illnesses. So as HR professionals, as employees, as managers, we need to keep all these benefits in mind. And obviously many employees leave an organization or join an organization simply because the benefits are very attractive to them. Your goal as a manager is to provide flexibility. So workplace flexibility is arming employees with information technology tools they need to get their job done, whatever the employees are. So keep in mind, technologies now, they're helping us to get our jobs done at home, and most of us are 24-hour employees. So our productive time is not limited to 8 hours being at the office, because you can work anywhere, anytime for most jobs to get your work done. Flexible benefit plans, initially called cafeteria plans, because employees could spend their benefit allowances on a choice of benefit options. The more flexible your benefits, the more attractive it will be for people, so it can be individualized based on their needs. Nowadays, we also see a concept of employee leasing. Leasing firms become the legal employer and handles all employee-related paperwork. It's also known as professional employer organizations. So overall, there are 5 highly ranked benefit objectives for employers. 5 of the top ranked objectives for employers offering benefits would be that these benefits increase employee productivity, they increase employee satisfaction, they increase employee loyalty, they attract highly talented individuals to the organization, and it helps employees make better financial decisions for themselves. In summary, compensate your employees equitably, include them in the decisions that impact their jobs and their lives. Companies that are considered to be inclusive with regards to their diverse employees are likely to be 50% more productive. In other words, inclusive employees are 50% more productive than their counterparts. So offer your employees flexibility, individualized benefits, so they can remain productive and long-term with your organization. Remember, people oftentimes quit their companies because of bad management practices and lack of equitable compensation. So be a good manager, and more importantly, offer good salaries that are equitable and make it flexible for your employees.